Hi there, Robert Wolf here with Terra from a Business and Financial Consultants. I'm an asset coach and a tax strategist. So today's video is going to be about another article. This one was June 6th. This was talking about Janet Yellen. And my concerns with this particular article, or not necessarily my concerns, what we need to be aware of is the voice that is being spoken from the various agency heads, such as Janet Yellen. There's certain type of conversation, words, and rhetoric that they're using that's a bit concerning that we need to be aware of, because what they're doing is driving us in a position to where we should feel okay about the government putting more money and liquidity into the markets. And that's what's causing inflation. But yet we're seeing this happen, but yet their words are starting to say, well, it's not that big of a deal. Don't worry about that. All this money into the market's not going to create inflation. Well, isn't that what inflation is about? So I'm going to minimize my picture here and let's look at the article here. It says Yellen says higher interest rates would be a plus for U.S. Fed. Hello. Okay. So Treasury Secretary Janet Yellen, President Joe Biden said Joe Biden should push forward with his $4 trillion spending plans. Okay. $4 trillion spending plans, even if they trigger inflation that persists into next year and to higher interest rates. Okay, and I'm a little concerned by this, and so she says if we ended up with slightly higher interest rate environment, it would actually be a plus for society's point of view. It would be a plus for society's point of view. That's correct, because there's a lot of people who have fixed income. They have a lot of people who would love to have higher interest rates in their return on their investments. But here's the problem. Those people that have those are the ones that are receiving higher tax hikes. Capital gains taxes are increasing by Biden in his administration. The other thing, too, is that a slightly higher interest rate environment requires that the U.S. government's debt is going to cost more as well. So the cost of those dollars increase also for the government and taxpayers having to pay those interest rates. Let's see here. This was an interview with Bloomberg News during her return from a group of 7 finance ministers meeting in London. The debate around inflation has intensified in recent months because between those like Yellen who argue that current price increases are being driven by transitory anomalies created by the pandemic. Yeah, what do you expect when you shut down the entire world economy? What do you expect? And to not have the idea and the understanding that the $4 trillion already put into the inflation. Now you're saying that it's going to be more. It's just really crazy. Supply chain bottlenecks. Okay, and look at my other articles talking about that. A surge in spending as economies reopen. Critics who say trillions in government aid would fuel a lasting spike in costs. Yeah, that's called inflation. Okay, and that's what our concerns are. Even though her words are not saying that. Her words are saying, oh, this will be a good. Well, yeah, it would be nice for us to have higher interest rates, but the reality is the reason why there's a lot of a spike in the markets is because you have companies that are getting bonds, cheap money, buying bonds or issuing bonds, and they're using those dollars, that cheap money, to buy back their own stocks. Okay, that's been going on since 2010. All right, that's a big deal. And lower interest rates mean that what? People can start refinancing their houses, maybe taking cash out, maybe they're upgrading houses at a same or cheaper cost than what was before because interest rates were low. Okay, and so the problem with banks now with that situation is that they can't give away money quick enough. With low interest rates, they're not going to be making a higher return, so they're going to start charging us fees in other areas. Okay, that's the big banks. That's just what they're going to do. They have to make the revenue somehow. Talking to a lot of banks, they have liquidity problem, meaning that they have too much money on hand. The depositors have too much money. Okay, so Biden's packages would add up to roughly $400 billion spending per year. Okay, that's on top of the trillions of dollars, contending that that's not enough to cause inflation overrun. You're right, $400 billion by itself would not, but it's not by itself. It's on top of any spurt in prices resulting from the rescue package will fade away next year. You think so? Okay, all right. Again, like I said, she's much smarter than I am. She's an economist, but my BS meter is dinging. It's going off because I'm not sure about that. Just the common sense says that's not the case. We've been fighting inflation that's too low and interest rates that are too low now for decades. Have we really been fighting inflation that's too low? Have we really been concerned about that? We had the highest employment rates before the COVID. The economy was sizzling. You look at all the economic indicators; they were all looking great, historic great numbers. Were anybody concerned about inflation? Inflation is the eroding of the value of a dollar. Okay, so I know the Fed's goal is 2%, but isn't the goal of 2% is to have a strong economy and that has full employment and incomes are going up, spending's going up? Isn't that what happened? That's exactly what happened before you guys shut down the country. Okay, so you can't tell me we were fighting inflation that's too low. Those are the words I'm talking about. That's driving me a little bonkers and a little nuts. We want them to go back to normal interest rate environment. And if this helps a little bit to alleviate things, then that's not a bad thing. That's a good thing. That is an accurate statement. But the government isn't slowing down their spending either. So it's forcing these spending per year, $400 billion. It's forcing to have that money and the liquidity. They're forcing taxes to go up because they're not curbing their spending habits. Asset purchases. The headline measure of consumer price rose to 4.2, which you'll see this in other articles as well. Okay, so that means that inflation grows 4.2, double what the goal of the Fed is. Okay, the Fed has committed to only beginning scaling back 120 billion a month. Okay, only scaling back the 120 billion. Well, Yellen just was talking about 400 billion. Okay, so there's a big difference there, right? Of asset purchasers. What's this asset purchases after there's a substantial further program? This is the quantitative easing. This is the Fed buying some of these assets, meaning debt. Okay, Fed Chairman Powell, who took the reins from Central Bank Yellen in 2018, has sought to convince investors that he's not considering pulling back support for the economy anytime soon. Powell and his colleagues have continued to project their key interest rates at near zero. Okay, so they're looking to project near zero. Yellen's saying we've been fighting that for too long. Okay, and so the Fed's goal is 2%. Everybody knows that, but their projected key interest rates to near zero through 2023. Okay, that's 2 more years. Okay, so they have a plan. U.S. job growth picked up in May along with worker pay, and the unemployment rate fell. Yeah, that's great. I will not give up on the next packages, Yellen said. They are not meant as stimulus. They're meant as investments to address long-standing needs of our economy. Okay, here's the part of the rhetoric we're talking about, right? They're not meant as stimulus. Okay, call it stimulus, call it investments. Bottom line is that the Fed is putting money into the system, which causes inflation. Okay, so that's the whole issue here. And so I don't know. I'm a little discouraged with these words, but the great thing though is, as small business owners, what do we have to focus on? The day-to-day stuff, right? If we just stay in our lane, keep our head down, pop up every once in a while, make sure we're still going the pathway we're going. You need to have a plan. If you don't have a plan, we just found out the Fed has one, right? And even people are competing with the Fed's plan already, right? You got the Treasury competing. Good thing that Powell doesn't work for Yellen, because things would change pretty quickly here. Okay, so you need to have a plan. If you don't have a plan of how to address these economic termites that we talk about, then you need to have a plan. You need to start putting one together. Start talking to your advisors, figuring out what your plan is. If they don't have answers for you, start reaching out. If they don't have answers for you, come look for us. We'll help you figure out a plan and make sure that something works for you guys. But bottom line is that things are changing and you need to change. You need to be proactive in this. You can't put your head in the sand, because these economic termites, taxes, inflation, time, laws and regulations, and debt, all this stuff is going to eat away at your hard work. You work too darn hard for other controlled things that are out of your control that other people are controlling to eat away at your hard work. It's happening already. We need to have a plan to combat that. So thanks so much for listening. Hey, if you like this video, please hit the like video, the thumbs up. We appreciate that. Also, if you haven't subscribed yet, hit the subscription button. Go to the little gray bell so you get updates every time we update this. We're going to do periodic articles like this. We're just trying to provide information for you, quick little 10-minute snippets so you can go on with your day, but still be able to be aware of what's going on in the economy across all your assets. And that's what we're focused on, the economic termites and your assets growing your hard work. Thanks so much. I'm Robert Wolf with Terra Firma Business and Financial Consultants. I'm an asset coach, tax strategist.